Good morning. Senior Deputy Governor Wilkins and I are very pleased to be with you to answer your questions about today's policy announcement and monetary policy report. The COVID-19 pandemic has caused an unprecedented fall in economic activity in Canada, and the recovery will require considerable monetary policy support. Our overriding message to Canadians is that the bank will be there to provide monetary stimulus for an extended period to support the recovery and to return inflation to the 2% target. Before I turn to your questions, let me say a few words about the key points of the Governing Council's deliberations. Nos discussions ont encore été axées sur le coronavirus. Cette pandémie est une catastrophe humaine et économique. Elle coûte des vies et elle fait perdre des emplois. Durant la première moitié de l'année, l'économie mondiale a connu son plus important recul depuis la Grande Dépression. Les mesures pour contenir le virus sont en train d'être levées à bien des endroits et l'activité économique commence à se raffermir. Mais comme on le voit aux États-Unis, de nouvelles poussées de virus peuvent nécessiter un reconfinement nuisant à la reprise. We are facing many uncertainties, the biggest of which is the unknowable course of the virus itself. As a result, we cannot forecast with the usual degree of accuracy on our economic projections. Recognizing this, we decided to present a central economic scenario. The central scenario tries to balance the likelihood of better and worse outcomes, but it is highly conditional on the assumptions about the virus. In particular, we assume there will not be a broad-based second wave here in Canada, and most of the containment measures are lifted gradually. We also assume that the pandemic will have largely run its course by the middle of 2022, because either a vaccine or an effective treatment is widely available by then. Our policy discussions were guided by this scenario while recognizing the extreme uncertainty around these assumptions. In the central scenario, the Canadian economy shrinks by almost 8% this year, then grows by just over 5% in 2021 and by almost 4% in 2022. Now let me give you some context. Recent monthly data, particularly on employment, motor vehicle sales and housing, suggests that the Canadian economy hit bottom in April. Job growth resumed in May and accelerated in June. We now estimate that the economy contracted about 15% in the first half of this year. As deep as this is, it suggests the economy has avoided the most dire scenarios we laid out in the April monetary policy report. In the third quarter, we expect to continue to see a strong rebound in jobs and output. Mais il est clair pour tous les membres du Conseil de direction que cette récession n'est pas habituelle. Nous pensons que la croissance à court terme, exceptionnellement forte pendant la réouverture, et sera probablement suivie d'une récupération plus lente et inégale. Il faudra donc beaucoup de temps pour que l'activité économique revienne même à ce niveau de la fin de 2019, avant que la pandémie frappe. There are many reasons why the recuperation phase may be protracted. Some businesses will close, while others will be unable to return to pre-pandemic levels of activity. Business and consumer confidence have been shaken, and consumers are likely to be cautious with their spending. And many people may find it hard to return to work, particularly if schools and childcare facilities cannot fully reopen. We recognize that the burden of this challenge falls disproportionately on women. Quand le confinement a été imposé afin d'aplatir la courbe, le gouvernement a vite réagi. Il a pris des mesures pour remplacer les revenus perdus et aider les entreprises à garder leur personnel et à payer leurs factures. Certaines de ces mesures ont été prolongées et de nouvelles ont été annoncées depuis le début de juin. Elles ont atténué les pires effets de la pandémie pour les ménages et les entreprises et jeté les bases de la reprise. The bank's actions were also unprecedented. We lowered the policy rate to the effective lower bound of 25 basis points and launched a range of liquidity facilities and purchase programs to keep markets functioning. This kept credit flowing and supported confidence. With core markets normalizing, we have scaled back some of the short-term liquidity facilities, but we are ready to step these programs back up if warranted. As always, our policy actions are grounded in our inflation targeting mandate. The pandemic is imposing uncertainty on inflation itself. Because spending patterns have changed, the Consumer Price Index doesn't accurately represent the spending habits of Canadians right now. So the bank has been working with Statistics Canada to create an adjusted price index that better captures today's consumption patterns. We talk about this in box 2 of the Monetary Policy Report. The adjusted price index shows that inflation is probably not as low as the official CPI suggests, although the difference is not large. In the past couple of months, inflation by either measure has been close to zero. We expect it to remain below target while low prices for gasoline, clothing, travel, and other items are pulling it down, and while demand is weak. The pandemic has reduced both supply and demand in the economy, but we judge that the effects on demand are larger. As demand recovers and economic slack is absorbed, inflation will gradually move back up towards our 2% target. Governing Council also discussed the role of our extended toolkit is playing in supporting the economy. Our purchase programs were initially aimed at improving market functioning and unclogging the financial system, allowing the monetary policy transmission to work as it should. With that objective largely achieved and the economy reopening, these programs, particularly the large-scale purchases of Government of Canada bonds, are now working through more channels, which we elaborate on in the MPR. The combination of a very low policy rate and asset purchases is providing considerable monetary stimulus. En résumé, l'économie canadienne a subi un choc historique et la réponse des autorités devrait aussi être historique. Les premiers signes positifs se dégagent la réouverture, mais la récupération s'annonce inégale et longue. To sum up, the Canadian economy has been hit by an unprecedented shock, which has demanded an historic response. The early signs from the reopening phase are positive, but we expect the recuperation phase to be bumpy and protracted. As the economy moves from reopening to recuperation, it will continue to require extraordinary monetary policy stimulus. The Governing Council will hold the policy interest rate at the effective lower bound until economic slack is absorbed, so the 2% inflation target is sustainably achieved. In addition, to reinforce this commitment and keep interest rates low across the yield curve, the bank is continuing its large-scale asset purchase program at a pace of at least $5 billion per week of Government of Canada bonds. This quantitative easing program is making borrowing more affordable for households and businesses and will continue until the recovery is well underway. To support the recovery and achieve the inflation objective, the bank is prepared to provide further monetary policy stimulus as needed. With that, Senior Deputy Governor Wilkins and I would be pleased to answer your questions.
Thank you, Governor. We'll go to questions now. We'll do one question and a follow-up. Please state your name and affiliation. I just want to remind people before we get started to mute their line if they're not asking a question. On the teleconference, you can mute your line by pressing *6 and unmute by pressing *7. Avant de poser une question, veuillez vous identifier. Libre à vous de poser vos questions dans la langue officielle de votre choix. Pour mettre votre ligne en mode discrétion, appuyez sur l'étoile 6. Pour l'enlever, faites étoile 7. The first question is from Kelsey Johnson of Reuters, and she'll be followed by Kim and then Dave Parkinson. Go ahead, Kelsey.
Thank you, Governor, for taking our questions. My first question is, with coronavirus cases spiking in large U.S. states like California, Florida, and Texas, and some states are rolling back their reopenings and even moving back to broader shutdowns, how much will Canada's recovery be delayed or slowed because of this?
In the last couple of weeks, with the rapid rise in cases of coronavirus in the U.S., we did take down our U.S. projection. You'll see in the monetary policy report the contraction in the U.S. and Canada this year is about the same, but Canada is projected to grow in the central scenario faster coming out than the U.S. That does spill back into Canada. Exports to the United States are an important component of GDP in Canada, and we have taken that into account in the central scenario. I would underline that there's a lot of uncertainty around that scenario, and the principal source of the uncertainty is the evolution of the coronavirus itself.
As a follow-up, why is the bank now providing some guidance on how long its policy rate could be at the lower bound?
Forward guidance is in our extended toolkit, and we have seen a historic drop in economic activity in the first half of this year. It's going to be a long climb out, and we recognize that households and businesses are facing an unusual amount of uncertainty. Against that background, we are being unusually clear that interest rates are going to be low for a long time. And we judge that combined with the reinforcement through quantitative easing provides an appropriate degree of monetary policy to support the recovery.
Thank you. The next question is from Kim.
Hi, thanks. This is Kim McCrail from the Wall Street Journal. Can you just elaborate a little bit further, following up on Kelsey's second question there, on what you'd like people to take from the forward guidance that was offered, just a little bit more explicitly on what you would like someone to understand about the path of the interest rate, of the key interest rate.
As we elaborated at some length in the monetary policy report, we see the recovery proceeding in two phases. A first phase, the reopening phase, where we expect to see a pretty strong bounce back in growth, followed by a slower, more protracted, bumpier recuperation phase. Our message is that it's going to be a long climb back, and the Bank of Canada is going to be there through the full length of the recovery until economic slack is absorbed so that we achieve our inflation target. The message is interest rates are going to be low for an extended period.
Thanks. And I just wanted to touch on there's a comment in the monetary policy report that in the global economic outlook section that says the risks are tilted to the downside in terms of the central scenario provided by the bank, particularly around a possible second wave. Can you elaborate on that and explain, does that also translate to the risks in terms of being tilted to the downside for the domestic economy, and how big is that risk?
So we haven't produced a regular projection. We produced a central scenario. And the reason for that is to highlight that our outlook is highly conditional on the evolution of the virus itself. We've assumed in the central scenario there is no widespread second wave, and hence there's no widespread second lockdown. We do anticipate that there will be localized flare-ups of the virus, and there will need to be localized restrictions. It's going to be very important that we're all well prepared for flare-ups in the virus. And we've been pretty cautious in our assumptions about when a vaccine or effective medications will be available. We don't expect that in the central scenario for about 2 years. When you look Clearly, there's a lot of uncertainty about these assumptions. There could be a second wave that requires a broad-based lockdown. And if that happens, we'd certainly be knocked off our central scenario. We'd be well below the central scenario, and that would imply we would need more monetary policy stimulus to get back to our inflation target. On the other side, a vaccine could be developed or effective medications may be developed more quickly, in which case the recovery would happen faster. The reason, yes, as you've outlined, risks are tilted to the downside really because of the possibility of a second wave and the serious consequences that would have if it required a second widespread lockdown.
Okay, we've got Dave Parkinson, Greg, and Heather are next on the list, so go ahead, Dave.
Good morning, Governor. Wanted to ask about the continuation of the QE program, and obviously with the intent pivoting from market stability to stimulus. Wondering if there were, excuse me, if there were discussions among the governing council about making adjustments either in the size or in the specific direction of those purchases in order to I guess to fine tune them to more accurately provide stimulus rather than market stability. If there was any talk about making changes along those lines, and if so, what was the nature of those and what was concluded?
We did discuss how much monetary policy stimulus is in place. We also discussed the tools in our extended toolkit. We discussed forward guidance. We discussed LSAPs. We discussed yield curve control. Where we landed was that forward guidance, as we provided together with a continued commitment to large-scale asset purchases, quantitative easing, if you will, at a scale of at least $5 billion a week of Government of Canada bonds, would reinforce the forward guidance and provide the stimulus that we see the economy needs. And we indicated that quantitative easing program would continue until the recovery is well underway.
Thanks. I also wanted to ask about the outlook for business closures, capacity destruction. Do you have at this point any sort of feel for how much what the depth of capacity destruction might be, or if you don't have a sense of how much that's going to be, how long will it take before we'll have a good feel for that?
I'm going to ask Senior Deputy Governor Wilkins to say a few words about this. We have a quite an extensive box in the NPR on that. In that box we do our best to estimate the supply implications of the lockdown and the potential path of supply going forward. I think the key takeaway is that demand is falling more than supply, so there is, inflation's already around zero and there's considerable downward pressure on inflation. But I'll turn to Senior Deputy Wilkins to say a bit more about the supply profile.
So it's an excellent question because it's going to be critical for us in our reading of the economy and the underlying inflation and disinflationary pressures that are there. In the box, what we attempt to do, as the governor pointed out, was have an estimate of what we think supply will be going forward to the end of 22 and benchmark it relative to what we thought it would have been in January. And what we expect to see is that we'll have about 3 to 4% on the level less supply at the end of 2022 than we thought we would, primarily because businesses may never open that were there, so there'd be lost capacity. The capacity may still be there, but the businesses may not be open. And thirdly, there may be less labor supply than we thought we had because of changes to immigration, the immigration profile, and also because there may be some workers that have not yet been able to enter back into the labor force. So all told, this could be some very long-lasting implications for supply, but we are quite wedded to the idea that demand is going to be even a bigger issue, and so overall the pressures on inflation will be on the downside.
Thank you. The next question's from Heather. Go ahead, Heather. I apologize that the next question is actually Greg. I skipped over Greg. Sorry about that.
Good morning. You can hear me?
Yes, go ahead.
Oh, thank you. Governor, you said that QE will be maintained until the recovery is well underway and that interest rates will stay near zero until inflation is stable around your target. Does that suggest that QE could be scaled back well before you raise interest rates?
So first of all, I'd highlight that we provide a central scenario rather than a projection reflecting the uncertainty. It's very difficult to put any of these things on a calendar. What we indicate is that interest rates will remain at the effective lower bound until capacity is absorbed and inflation is on target. And that is reinforced by quantitative easing until the recovery is well underway. Both of those are some ways off. We have, after a sort of quick bounce back, we have a fairly long, slow recovery. And when we say the recovery is well underway, that is beyond the reopening phase, which we expect to be fairly strong. It's somewhere in that recuperation phase. And what we will be looking for is we will be looking for signs that the recovery is becoming more self-sustaining. I think logically, yes, the recovery being well underway comes before capacity has been fully absorbed, but both of those are some ways off. And we have the tools that we need to exit when the time comes, but that is some ways into the future.
Thank you. Secondly, on the fiscal side of the equation, we've all seen the government's record deficit. Do we still need massive fiscal stimulus going forward? And from a point of view of Bank of Canada independence, is there any point where it becomes more uncomfortable to continue buying federal government bonds, given the perceptions about a conflict that could arise?
Well, you've managed to pack a lot into one question. On the first part, the government has played a leading role in responding to this crisis with programs to support, replace incomes that have been lost due to COVID for both households and businesses. The wage subsidy program is supporting companies and workers and keeping workers connected with their employer, which will be helpful to support more rapid rehiring as we move forward, and that program has just been extended. These programs are playing a critical role to support households and businesses. They're laying the foundation for recovery and will support the economy through recovery. With respect to monetary policy, our monetary policy is guided by our inflation target. QE, large-scale asset purchases, are an important tool in our extended toolkit. And in a situation where we're at the effective lower bound on interest rates, QE is an alternative way of lowering interest rates further out the yield curve. It is our judgment that additional stimulus is needed to bring inflation back to target. And as an independent central bank, we are pursuing our inflation target, which is jointly agreed with the Government of Canada.
I've got Heather, Eric, and then Jordan. So Heather, you're up.
Good morning. Throughout the report, the monetary policy report, you talk a few times about fear and uncertainty, fear of catching the virus and uncertainty about job loss, compounding the economic weakness. I'm wondering how you quantify that in your central scenario, and what kind of factors change the trajectory of that and how it affects growth?
Well, it is a difficult thing to quantify in the central scenario. The virus is not something that we have any historical data on that we can. So there is a certain amount of judgment involved, but we can look back at other disasters and see what has happened to confidence. The reality is, Heather, the virus is going to be with us for some time. In the central scenario, we assume it's there really for the full projection period of about 2 years. That through this period, we are going to have to continue to physically distance. Companies are going to need to figure out how to get their workers back safely, how to serve customers safely. Individuals are probably going to be cautious about, in fact, I hope they are cautious about certain activities because they don't want to get sick. There's also going to be ongoing uncertainty about employment. Some companies, unfortunately, will go bankrupt. They're not going to make it to the other side of this. Households will naturally be concerned about their job security, and that may lead them to hold more precautionary savings. So these are factors that will restrain the speed of the recovery, and they're an important reason why our view is that there's going to need to be monetary policy stimulus for an extended period to support the recovery through the full length of the recovery.
Okay, thanks. Just to pick up on the discussion of box 3 on page 24 about the permanent damage to the economy. You discussed the contraction of the labor supply because of immigration levels. But off the top, you mentioned that the burden of the labor loss has fallen on women, and I'm wondering are you looking at the long-term effects of mothers being squeezed out of the workforce more permanently, and how that affects the workforce going further? And if it's not as part of that scenario, is that because it's an oversight, or is it just because it's too marginal to rate a mention?
I certainly wouldn't say it's too marginal. I think families are facing real challenges. Hopefully, as this virus progresses, we get better and better at managing it, and I certainly hope we can find a way to reopen schools and get daycare back to work. But yes, I won't say that we've got a precise estimate of what that effect is, but rolled into the supply effects, we include a range of things, and that would be one of them. What you see in the box is that supply has plummeted. I think it's about 60% of the drop in output in Q2 is reflecting restrictions in supply. So right now, we're into the third quarter, but go back a month, those effects were very acute. They're starting to come off, but you'll see in this box 3 that they come off pretty gradually.
Eric?
Thanks.
Eric, you're next.
Good morning, Governor. I'd like you to spend a little bit more time explaining what is meant by sustainably achieved in the context of the inflation target.
So both parts of that sentence are very important. That excess capacity is absorbed, or I think we say economic slack is absorbed, so that inflation is sustainably at our 2% target. And what that means is that in order for inflation to be sustainably at the 2% target, in other words, fluctuating closely around the target, output needs to be very close to potential. We have to have absorbed the excess capacity. If we still have a lot of slack in the economy, even if inflation temporarily gets back to 2, it will fall back down below 2. That is not sustainably at the 2% target.
Eric, do you have a follow-up?
Yes, just to follow up, talking about yield curve control or potentially raising bond purchases, are these still in the toolkit, and what would come first?
We discussed these, we discussed these issues, and I'll ask Senior Deputy Governor Wilkins was, of course, part of those discussions, so I'll ask her to say a few words as well. We discussed the tools in the extended toolkit, including forward guidance, including the size of the quantitative easing LSAP program, as well as yield curve control. We've done some research on yield curve control, and Senior Deputy can say a word about that. LSAPs and yield curve control both involve buying, both involve large-scale purchases of Government of Canada bonds. The difference is with LSAPs or QE, typically you announce an amount. So in our case, a minimum of $5 billion a week. In the case of yield curve control, you announce a point in the yield curve, an interest rate on the yield curve that you want to target. Yeah, maybe I'll turn it to Senior Deputy Governor Wilkins to say a little bit more about what we talked about.
Sure. So we did talk about the two different approaches to providing monetary stimulus when we're at the effective lower bound. And when we thought about our current quantitative easing program in the context of where the yield curve is today, it was our judgment that this program would be very helpful with a minimum of $5 billion a week to achieving our monetary policy goals. And the intent, it's not just about the $5 billion or whatever we end up buying, it's about what you actually purchase. And so our purchases are aimed at across the yield curve in a way that's somewhat proportionate to the amount outstanding and what's being issued. You'll notice that the federal government just announced its bond issuance plan for this year, debt issuance plan for this year. And so we will continue to monitor the effects of our purchases and adjust as required to meet our objectives, which I just want to remind everyone, Governor's done it a couple of times, are squarely aimed at our inflation target.
Thank you. I've got Jordan, Kevin, and then Tony. Just a reminder to state your full name and your affiliation, please. Jordan, go ahead.
Hi, good morning. It's Jordan Press with the Canadian Press. I wanted to just go back for a moment to your comments about childcare centers and schools and hopefully that they can reopen in the fall. I was wondering if you could just describe a bit what it would mean for the effects on the central planning scenario. What would it mean if schools and childcare centers cannot fully reopen in the fall, or if those that are able to reopen, what it would mean if they have to close down for maybe localized outbreaks?
So in the central scenario, we do envisage a gradual lifting of the containment restrictions, and roughly we have them fully taken off by the end of this year. We will, of course, need to continue to physically distance, to wash our hands, and take sensible precautions. And also built into the central scenario is the recognition, the reality that there probably will be local flare-ups. There will need to be some local restrictions reimposed, and that's one of the reasons why the recovery is fairly slow through this recuperation phase. You're going to have 2 steps forward, 1 step back. It's a matter of degree. I think if schools were not to reopen, that would probably put us on a track somewhat below the central scenario. You really, I'm cautious to be too precise on this. You've really got to look at the sum of all the restrictions in the economy and how much they've come off. I think the bottom line is we've got them coming off gradually. If they have to come off more gradually, or if some have to be reimposed more than in the central scenario, you're going to be in a scenario below the central scenario.
Thank you. So just as a follow-up then, if for the average Canadian household trying to navigate its way through the scenario that you've outlined in the reopening and then the recuperation phase, what is it that maybe is your message to them that you hope they take away from everything that you've laid out today as they try to navigate this economic uncertainty that's as large or maybe even larger than the shock that created it?
Our message to Canadians is that interest rates are very low and they're going to be there for a long time. We recognize that Canadian businesses are facing an unusual amount of uncertainty. And so we have been unusually clear about the future path for interest rates. If you've got a mortgage, or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time. Low interest rates make spending and investment more affordable, and spending and investment will support the recovery. That would be our message to Canadians.
Kevin.
Hi, Kevin Carmichael from the Financial Post. I have a couple of questions related to the new adjusted inflation measure. The first one is, how exactly are you using that measure? I guess to put it another way, is that the Bank of Canada's new North Star? Is that the new inflation guide that we should all be watching?
We have a whole box on that in the NPR, and I'm going to ask Senior Deputy Governor Wilkins to say a few words. I will say that there's not a huge difference between the two, and our target is still, we still target the total CPI. We use measures of core inflation. We're looking at this adjusted measure as well. But I'll let Senior Deputy Governor Wilkins elaborate on that adjusted CPI inflation measure.
Thanks very much, Governor. So we know in this particular time with COVID that consumers have been adjusting their consumption patterns. They're buying fewer pieces of clothing, they're traveling less, they are on the other hand spending more in their homes, in their shelter, they're spending more in the grocery store. And these, of course, would not normally be reflected in the measure of the Consumer Price Index because it's based on a set of weights that are kind of an average over a period, and they're not adjusted very much. And we thought that to get a reading of what people were actually feeling in terms of their consumption experience, it would be important to make those adjustments. And we were very helpfully working with Statistics Canada to be able to do that, just to keep track of it. As the governor said, you see the weights do change. It means that in May, just as an example, total CPI was 0.3 percentage points lower than this adjusted measure. I think over time, as consumption patterns normalize, these two measures could converge again. But the important thing to know is that consumers and households have been telling us for actually a while, in the context of our inflation target renewal, that they were wondering whether CPI was actually measured correctly. And so this is just an issue that's just being accentuated. And so we are working hard with Statistics Canada to think about how can we update these weights, or how can they update these weights more frequently than they do, and is there any adjustments that need to be made to the weights on a more permanent basis? But that would be in the context of our inflation target renewal.
All right, thank you for that. I'll come back though to the point of the original question was, and given the explicit guidance you put out today, which 2% should we be paying attention to? The traditional one, the old CPI, or should we care more about what this adjusted measure is telling us going forward?
Our target, Kevin, is for total CPI inflation. And we use a variety of other measures of inflation, various core measures. We're now looking at this adjusted CPI measure as a way to help guide us on what the future path of total CPI inflation will be. The other thing I would say is that Statistics Canada is planning to adjust the weights in total CPI inflation more frequently going forward than in the past. And so both for that reason and the fact that as the economy reopens, we expect household spending patterns to go back to something that is more normal, probably not the same as pre-COVID, but will be more normal. For both those reasons, we would expect this adjusted measure and the total CPI, the gap, which is already pretty small, to get even more narrow.
Thank you. The next question and the last question is from Tony Mace. Go ahead, Tony.
Hi, it's Tony Mace. It's Tony Mace at Mace News. I want to raise the issue of the Canada-U.S. border closure, in particular the impact on tourism and border communities. And how is that closure affecting your view of the outlook on the downside now? And if it were to reopen, would there be a measurable positive effect on the outlook?
So the border trade is, trade is happening. The border is closed to people going back and forth, and as you highlighted, that is having a very severe impact on particularly the hospitality industry. And this really highlights why this recovery is likely to be uneven. We've started to see some very encouraging numbers as the economy's reopened. We've seen something like 1.25 million jobs have come back, and we expect to see some very good numbers through the third quarter as the economy continues to reopen. But not all sectors are going to be able to reopen to the same degree. Some activities like hospitality, like international air travel are probably going to be down for quite a long time. When the border opens and it's safe and advisable for people to travel, that will certainly help the hospitality travel business. But it's got to be safe before that's a sensible thing to do.
Thank you. If I could just follow up on the point that Senior Deputy Governor Wilkins made a moment ago about asset purchases across the yield curve, and that you're continuing to monitor their effect and that you might adjust as needed. Is that to say you might adjust the overall quantity of purchases or the composition of purchases across the yield curve, or the time required to continue purchases at the current level? Can you just explain what you meant by that, please?
Yeah, I meant by that when we look at the program, we look at a number of parameters. One is the total amount, as you said. We have committed, though, to a minimum of $5 billion per week until the recovery is well underway. And so that would be an adjustment over that period on the upside. But there's also adjustments that you might need to make about where, particularly on the yield curve, that you want to concentrate. It can depend on the issuance and the changes to the issuance patterns, as well as just investor behavior, what their appetite is in different areas. And so clearly for the markets and for the transmission of monetary policy, there are some key benchmarks that are of particular interest, and those would all be things on our minds.
Thank you very much. That concludes today's press conference. Thank you, Governor. Thank you, Senior Deputy Governor, and to everybody for joining us.